Welcome back to another live stream. This week, we're going to talk about corporate share buybacks. Are they good? Are they bad? We hear a lot of rhetoric, on social media, et cetera, right? Especially between what are firms buying so many shares back that they're not actually spending on capital expenditure. I had to bring in the experts for this. So we've got Doug from Modern Macro Technologies. We've got Mike Radzicki from WPI, and we got Tahir from Deer Point Macro. We're going to get into it right.
You are now relearning economics.
So, as a lot of my topics start off, they usually start off on Twitter or X, formerly known as Twitter. And I think on August 2nd, I put up a tweet, a post, and I put, share buybacks are a form of fixed capital investment with a time delay. Dividends are a cost to the bottom line of a firm and are lowered with buybacks. It's statistically observable that a portion of profits are set aside for capital investment. Now, generally, I get a lot of likes, but this one I didn't. And I suspect it's because I got a lot of progressive followers. And there's a bad aura around share buybacks. And I always come at things from a systems thinking perspective. What's the causal loops and all that? And I have a basic thesis. Now, I'm going to write a blog about it, but I wanted to bring in the experts today. So I didn't write some, horse shit, essentially, right? I want to talk to, market experts, an academic. I want to kind of flush this theory out. There's data. So I pulled a bunch of data. Tahir has provided me with a little bit data. So I'm going to start putting things together. But my thesis is essentially share equities. So let's break this down, make it a little easier. Imagine you're a sole proprietor. And you bring in a partner, silent partner. So you need an injection of money. Let's say, I was running a trucking company, which I did in my mid-20s, and I need a new truck. So I brought in a silent partner, and he's providing me the lease payments for this new truck. Right. And so I put this new truck on the road, a capital expenditure. I make my profits, increase my profits, hire more people. And it comes to a point I don't need that silent investment anymore. I've been giving him a cut, dividends through time. And I decide, okay, I'm going to buy him out now. Right. His use has come to an end. I know that sounds harsh. And that's the same thing with the share buyback, but on a corporate level, you could say. And that's also no different. Now, than debt. Now, shares are an equity on the balance sheet, right? So for the shareholder, it's an asset. Just like if a person gave me a loan, it's an asset for them and a liability for me. But with shares, it's an asset for the shareholder and it's in my equity column because it's like owner's equity on my balance sheet. But ultimately, debt and equity operate in the same thing in aggregate, right? So I needed capital funds to invest in something, did it, made my profits, but I no longer need that help from my partner in a sole proprietor or partnership proprietor type setup. And I no longer need help if I'm a corporation and I got these shareholders and I don't want to pay the dividends anymore. Now, I got some pushback on Twitter. Of course, well, you can just raise and lower your dividends and eliminate those costs. Well, I tell you, statistically, if a company's lowering their dividends, it's going to drive the share price down, right? Whereas if you do a buyback, obviously you're reducing what? Supply, right? And that's going to push the share of the share up. Now, obviously, shareholders are going to be looking at the fundamentals of a company, but if you're buying back shares, that means you're probably profitable, right? So an increased share, because you're removing that supply, justifies a rise in the price. Now, if you can also look at it, that a portion of those shares are paying a dividend, right? And so let's say you knock out some of those shares, right? Your share price goes up, right? Great for the executive board, so the CEO, the chief financial officer, et cetera, et cetera. right? And you're paying a lower level of dividends. You could bump the dividends up at that point, but still be paying less in aggregate, right? And so that means you have more cash flow. And somewhere down the line, when the next innovation comes along, your company's set up to invest, do some capital investment. So it may not always line up. And we see this right now that, there's lots more, share buybacks, but not more capital expenditure. And my argument is, well, there's a lag involved, right? There's got to be the next innovation. And we've seen a lot of that since 2000, the technology boom, right? It started with the dot-com boom, right? Then it moved into now AI, right? So it's been a continuous big arc of computer technology with a lot of sub innovations in that. So I found a few charts on Harvard, and I haven't set the date up myself. So this is a little bit dated now. I think it goes to 2016. So you can see the red line, the classic buyback has been going up over time. Dividend payments, and now this is as a percent of the assets of firms, hasn't really gone up. There's a little rise right now, but you can essentially say statistically it's been around 2%. So we got that perspective. So what we're seeing is that essentially they're taking more shares out of the market, so supply is lowering while their dividend payments are staying the same. We go to another chart. And this is the one that alarms people, especially progressives, right? And you can see now, remember, this is a measurement of total assets, and I'll nuance this with a productivity argument in a minute, but you can see total assets of CapEx is going down over time while buybacks are going up. And that's the problematic thing that's highlighted over time. We can scroll to another chart, and this goes to my argument that, share equities and debt are essentially the same thing. A company is financing itself somehow, right? So either you're bringing on external owners and equity shares, or you're purchasing debt. They basically move in the same direction through time. But there's another way you can look at this, and you can measure this against GDP itself. So now you're kind of including the productive capacity of industries. And if you look at it, capital expenditure hasn't really dropped all that much. It's got its ebbs and flows with the business cycle, a minor drawdown since the mid 90s to now, and this goes to about 2016. So you do see a small decline, but not to the degree where you see where it's being measured as a ratio against firm assets. So now you're including the productive capacity of the economy. And so investments right around where it's always been. You do see a bump in share buybacks, but you don't see much of a change in the dividend payments. So that's kind of my thesis, but I'm going to bring on the guys because we need to flush this out. I do macroeconomics, right? So, broad macroeconomics, but, people like Doug and Tahir, they're doing like finance in the macro sector, right? And they've got a lot better understanding of like corporate finance, far above mine. So I want to learn from them in this show. And we've also got Mike. I'm going to bring on Mike first because I know he is busy as heck teaching school. Mike, I'm going to get your perspective. I'm going to bring everybody on at once, and then we'll go through everybody's kind of perspective and go from there. We've got Doug from Modern Macro Technologies. And finally, new guy that I've been interacting with, Tahir from Deer Point Macro, is in the house. How you doing? Silence. Perfect. This is the way
To whom were you asking? How just generally?
Doing well.
Yapping.
How are you doing?
Just
back to school. Yay.
I'll start with you, Mike.
Yeah.
What do you think of my thesis on share buybacks, introducing a lag into that equation to give it a little more causal perspective over time?
Lags are very important in dynamic systems. So anytime I hear that, I'm listening. It's when it becomes part of the theory or the narrative. You get into the whole thing, the Merton-Modigliani theorem of however many decades ago, where the details of the capital structure under some strict neoclassical assumptions doesn't matter, where it's debt, equity, whatever the mix is, doesn't matter. But more along the lines of my thinking was listening to you was I'm thinking Berkshire Hathaway, right? So Warren Buffett gets a rash when he thinks about paying dividends. He doesn't do it, right? He accumulates cash, lying in wait to gobble up a business he understands and is likely to make him more money. But occasionally he'll buy back shares. And he says, well, I don't give dividends. I appreciate the value of our shareholders' stock portfolio. So I think it's a strategy, and it kind of depends on your, because you're showing us aggregate data. I think it depends on the firm. On the other hand, you have the lists of those. I can't remember the dividend legacies or the dividend kings or something. I forget what it's like big tobacco always leads the way with huge dividends. They for decades pay great dividends. So there's other firms that have a very different attitude towards dividends. Investors look for it. So in the aggregate, it's a little hard to say, but I was, sort of following the argument, and it cries out for microeconomic modeling, sort of firm level modeling, I think, to see what, for a particular business, what pursuing a particular strategy to benefit shareholders, whether it's dividends, share buybacks, or whatever, what for that business would make the most sense. General comments, but that's the best I can do at the moment.
Doug, Doug, your opinion.
Yeah, Ty, that was normally I like to butter up the host before I say anything, but I don't mean it. But this time I really do. That was a really helpful intro, and from a macro perspective and like kind of your take on it, that was really helpful to get going. And also nice to meet you, Deer Creek or Deer Point Macro Man. We've had quite a few interactions on Twitter as well. Yeah, I'll have some more comments further down the line, and I like Mike's point too, where there's going to be a lot of micro considerations on any given company with regard to buybacks and what the impact is. I think the thing that my thought, my question, when this pops to mind is what is the broader macro implication of a trend of rising buybacks versus lowering buybacks, and then what is the impact on the overall cycle itself, right? Is there any impact on the overall cycle? I don't think so in the biggest scheme of things, simply because of pretty much everything you've laid out, and that for every take there's a give, and there's two sides to this. And what I do kind of think though is if you want to get to more of the what is the productive economy doing for us, and how does this help? And I was looking up some of the data that you were showing, and I was also trying to, I honestly, I don't follow the data too closely on buybacks, but I did notice that there was definitely pre-Great Financial Crisis with regards to if you measure it relative to the total market cap of the S&P 500, they were definitely a lower percent of buybacks relative to after. And there was something that happened into the Great Financial Crisis and after that really allowed or demanded that trend push higher. And then I've noticed too, post COVID stimulus, it seems, again, just as a percent, and to hear correct me here if I'm wrong, but it does seem like that trend is not quite as aggressive as it was pre kind of COVID and pre-stimulus in terms of buybacks. And I think that is more symptomatic of a environment where the best thing you can do for your money in terms of returns to investors is just buy back your own shares, as opposed to either pay dividends or look to do something else with that. And I think that's probably you'll see that more in my guess would be you'd see that type of move more in a zero interest rate type policy than when interest rates get pushed higher. And again, I'm not talking straight macro, at the macro aggregate level, and I'm just spitballing here without thinking through this too much. But that at the macro level, higher interest rates are going to kind of press the need for more earnings because the risk-free rate is higher. It's also going to inflate away the existing cash that is there, and so you might be a little bit more inclined to do something a little bit more aggressive than you would have in a zero rate environment. But just spitballing there, not really sure. That was kind of my thoughts off the top here.
Deer Point, your thoughts? Testing 1, 2, 3. Deer Point. You are on Deer Point Macro in the house.
Can you hear anything we're saying? I'm taking that as a no.
This is the strangest event I've had on a live stream ever.
Try to flip him a in-house message and see if he's got his headphones off. Or
Do you have your headphones on? Can you hear us talking to you now? You're big on the screen. You're live on the Relearning Econ channel.
Yeah, I can hear you guys. Can you guys hear me?
There we go.
Yeah, there we go.
There we go. There we go. I was just asking, what's your opinion on my thesis about share buybacks? What's your opinion in general about share buybacks?
Yeah. I can hear you.
I think there's a bit of a delay going on here.
Told you delays are important in dynamic systems.
Ty, you might want to message him to reset the app. I can.
Okay.
Oh, there we go.
There we go. There we go. Okay. Sorry.
Can you hear us live now? Oh, I don't think you can hear us live.
Yeah. So I think that it's to Mike's point that at the micro level, it's something that's very important. And obviously, I think that you're going to see kind of a delta between certain companies, specifically tech, that tend not to have large dividends and tend to prefer share buybacks relative to things like industrials, utilities, telecommunications.
I'm going to type a message to him and tell him to try to log back in and on and have a good internet connection. Try logging.
Yeah, I think it depends.
Yeah, I can.
Go ahead.
One second. Let me try to join off the. Might try to drop down and join again because I'm not sure if it's on my end. Just give me 1 second.
Mike, go ahead. What you were saying?
Yeah, I was just agreeing that it really depends on the nature of the business, right? High tech businesses want to be able to reinvest in R&D a lot. So, excuse me, they lie in wait and accumulate cash and occasionally buy back shares rather than a regular dividend stream of more legacy business. And it really speaks to what's the strategy for the business? What's your goal? Do you want to maximize share price? You want to maximize market share? What have you? And so it's a little difficult to make a generic statement like all firms XYZ. Right?
No, that's the question. So if you want to maximize share price, are shareholders interested in you just doing that versus the fundamentals of your company underneath, right? So yeah, you can your process and your firm and your strategy is that we need to maximize share prices, but to the shareholder, well, what about your underlying fundamentals? I don't care if you want to artificially rise, my shares. Is that going to hold going into the future, right? So is that a real long-term strategy for corporations?
Yeah, and are you a trader or an investor? If you're an investor, you care about the fundamental. You consider yourself an owner of the company. If you're a trader, you just want to flip it on whatever time frame, and you don't really care. You can go short. You can short it too.
I think that goes to show though, when you have when the macro wherever the macro dynamic is at. I mean, if you just think about it, if you have a tech company that is near infinite in price, and they're deciding to buy back shares at that point in time, I mean, that's really what they're really saying is in terms of what this company is going to yield for return, that this buyback is going to benefit this company more than us doing any R&D with that cash instead, right? So in other words, whatever R&D we're going to do is going to return so little that whatever tiny little increase in price in the grand scheme of things, in the grand scheme of, return, that the yield that this company is going to have, that we're going to benefit more by just buying back more of this company. And I think it goes more to say about the overall macro environment. And this is why I think I'm on to something where in a low rate environment, the return on capital is just so freaking low. And there will always just be an incentive to have your company, right? I mean, any stock, any sector, you want to yield the best return for investors, no matter what. And if that means just buy back, and instead of creating some new technology, just flip the number on the next iPhone and issue iPhone 7 to iPhone 8 and call it good, then that's all you need to do, right? Because that's just the lack of competitiveness that's out there. So yeah, hopefully, to your point, you're back at it. Can you hear us live now?
Yeah. Can y'all hear me? Yeah,
Good,
sorry.
Good. Yeah.
Sometimes
riff away, man.
I'm in the office surprisingly, and for some reason there's the Wi-Fi's being a bit funky. But we're up on the 27th floor, so that might have something to do with it. And the weather here in North Carolina is not too great today. It's raining. So, anyways, so to the to I guess my point where it got cut off. I would agree with Mike's point. I think that it very much comes down to the industry specific level. And so if you look at things like industrials, or even if you look at things like utilities that tend to be much more capex heavy, capex has still started to decline, but obviously buybacks aren't happening as much. And I think if you're looking at the company perspective, I'm not necessarily saying that this is the right view, but I think this is kind of what happened in the wake of 2008, is as you had QE unveiled, I think that a lot of managers and corporate heads essentially heard that financial assets have zero moral hazard, and that they're protected by the United States. And financial assets are also much more liquid than real economic assets, but growth and productivity require real assets. And so assets were taken from the economy and invested in the financial economy. And I think that might be part of what we're seeing. And I think, as Doug touched on as well, if you're just thinking from a present discount value standpoint, if you're trying to build out a factory or something that's amortized over a very long period of time, when rates are low, that's much more attractive. But then when, the Fed at the peak raises rates to 525 basis points, you can, theoretically afford a whole lot less factory than you could when rates are at zero. And so I think that, some of that also might be a function of, at least recently, what we have seen in kind of the pullback in CapEx investment, because buybacks have now hit all-time highs of 300 and some odd billion dollars. So, we are seeing the continual shift away from CapEx and the continual shift towards just buybacks, because I think at the end of the day, that's what shareholders want, right? Because it's good for equity value.
Good stuff. I got a question here.
Ty, can I, before you ask that question, can I make a qualifying question? Yep. And again, this is just outside of my expertise. And to your point, I know you've looked at this a lot more. So I'm looking at like S&P Global data, and they're tracking the S&P dividend versus buyback. And buybacks, according to this, at the end of 2024, we're at 250 billion. So you just said 300 billion. So they continue to rise at that pace. But that number there should probably be best understood relative to some other anchor, like the total. Like the total market cap of the S&P, right? Like that number will always rise over time, nominally, right? Am I right in that? I'm just literally wondering, is that how I should be interpreting like the data?
No, I mean, I think that the way that Harvard did it, as Ty showed earlier, relative to GDP or relative to market cap is probably
Okay.
the
Okay.
best way to look at that.
Okay.
But yeah, I mean, nevertheless, and I think the Harvard chart, if I'm not mistaken, cut off at, like at 2015.
Yeah.
And so now the interesting thing would be looking at, have those two diverged much more closely, where now buybacks are maybe 6% of GDP, and capex investment is 8. But I also think, and I mean, this will bring up the macroeconomic implications. Um, I think that is also part of what we are seeing with the rise of, without getting too political, President Trump's sentiment, right? Because if you just look at labor share and capital share of income, um, what labor capital shares almost 60%, labor shares 40. And so, for people who are at that upper end of decay, they have benefited from this divergence between capital and labor share. And I think that a large function of that is the fact that the economy has become much more financialized. And so, for people who work in asset management, such as myself, like, we're beneficiaries of that. But at the end of the day, I don't think that does much for the real economy.
Yeah, I agree. There's definitely, so, and a lot, I kind of started out on the progressive end of my journey, right? And so one of the first factors I identified, and a lot of the work through Steve Keen, was the growth of the financial sector. And yes, it provides a good lubricant. It's provided me, let's face it, I can easily go day trade every morning because of the financial sector. I have access to so many derivatives. I have access to actual shares, right? But the flip side of the question is, we've seen the share of income go towards financial sector firms versus households, and that could be very problematic. Now, Miguel has an interesting point here, and I'll let any of you guys answer this. Is William Lazonick has worked on share buybacks. His main point is that stock buybacks often prioritize short-term shareholder gains over long-term investment and workforce development. I think you guys have touched on that, but is that a valid perspective from this guy William, who I don't know? Anybody can jump in. I'm just jump in and start yapping.
Yes and no. I mean, I take the point, and there's merit in it. I think, again, circling back to Warren Buffett and Berkshire Hathaway, my investments there helped me put my kids through college. So thank you, Warren. And it's his style of investing. He's either hoarding cash, lying in the weeds, waiting to buy a business. And if he doesn't see anything that would meet his criteria, he says, well, we're just sitting on a lot of cash here. We'll do some share buybacks. So in that sense, it is a long run strategy that in the short run, yes, will give something to our shareholders, but longer term, he's waiting for a really good buy, a business he understands that'll make him money and what have you. So I get, it depends. I guess the devil's in the details always, but I understand the point, and I think there's some merit there.
I think the thing that pops in my mind when you have that discussion particularly is should the onus be on a corporation to have to make the decision for what's best for society, right? And that's just not how capitalism should work. It should be how can me as the owner of a corporation make as much profit as possible and make the best product or service possible, and that it is the political policy. What is the aim of the country and its goals that should be set at the policy level, and that is like to then put that weight as though corporations are evil. No, they're doing exactly what they are supposed to be doing, and it's the policy side of things where that discussion should be had. And when you have macroeconomic policy that is being set that means that a company is going to maximize its return for its shareholders, which it should by simply just buying back shares, then you can't, we voted for it, right? I mean, that's on us. We're the ones that made that decision. We're the ones that continue to hold these assets to increase, our own wealth and our own value. So I Yeah, I mean, of course, if companies made cooler stuff that benefited our lives, that would be better. But if the government hands them a macroeconomic environment where that's not a winning formula, then how are you going to complain when you voted for a government that put in a losing formula? I don't know. Sorry, had to go on a little tangent there, just to say, like, you know, there are multiple people that are making a decision here. We're all one of them as well, and we're making these decisions in this as well. And I don't know who William Lazonic is, but that would be my thought. Like, yeah, of course, if more cars were made, we'd probably be better off. But maybe there's not the economic viability for that.
Dear point, you can anything to add on to what Mike or Doug just said?
No, I mean, I think that they all made points that would kind of echo mine. I mean, I think conceptually we can all realize probably in hindsight more CapEx investment would probably be better in the long run. I think that it would help to boost output potentially. But, you know, I mean, at the end of the day, I mean, that comes with its own kind of problems in and of itself, right? Because then, I mean, at some point you have depreciation, you have to replace those assets, so on and so forth. And so, you know, I mean, I think that it's all about, like, you know, essentially ROI, like return on investment. And, you know, right now, if the largest return on investment comes from buybacks, I think that that's what they're going to continue to do, even if it's at the, you know, even if it's at kind of the risk of lower overall aggregate output. And I mean, that's something that we've seen for a long period of time, right? I think off the top of my head, even to this day, capital consumption still outpaces new increases in the capital stock, right? And so, like, I mean, that's at some point something that's going to have to be reversed, or maybe it's just something that happens kind of in the late stages of economic development, right? Where that's just what you get. You become a service-based economy, and you don't really need to continue to replace the capital stock over the rate of depreciation. I mean, that's also a probability.
Yeah, no, I agree with everybody's point. You know, going back to Doug, ultimately, at the end of the day, this is the expectation we have from corporations, that they're going to maximize a profit in any way. And if you want to scale it back without the technicality, I go back to the sole proprietor or partnership argument, right? At the end of the day, right, I am functioning to make a profit, right? And if that means, you know, buying out my partner, just to simplify the equation in everybody's head, that's what I'm going to do. That's my job as a business owner, and that's how I fit in the capitalist system, and that's going to allow me to employ people in the future. So as for you, go ahead, Mike. Speak.
I was just going to say I was delighted that we have Doug M. Friedman here today. Doug Milton Friedman. That was precisely Uncle Milty's argument that the only social responsibility a company has is to make as big a profit as it can for its shareholders. Now, no other than Keynes, or really one of Keynes's interpreters, Douglas Dillard, Douglas Dillard, I think that was him. Dillard's the last name. He wrote one of the early books that said, let me explain to you what Keynes was saying. Anyway, he said, the point is that companies don't have the incentive or the wherewithal to worry about, well, the aggregate labor market. They worry about their labor market, right? It's only the government, the state, that has the responsibility and the wherewithal to stabilize the system, right? Now, having said that, so it's kind of like a Milton Friedman-ish argument, so to speak. But coupled with that is the short-term nature of business and politics, at least in the United States, right? We have quarterly earnings reports that come out. Watch any of the news shows, CNBC, Bloomberg, whatever. It's earnings season, right? And all the Kramer is out there listening to all of his guidance calls and what have you. So you're on these C-suite managers are on a quarterly, incentive system to, you could drop a quarter here and there, but you drop too many of those and you're gone, right? Similarly, in politics, in the United States, the House stands for re-election every 2 years, the Senate every 6, the president every 4. That's not a very long-term horizon, unless you're a lame duck. Trump I suppose he doesn't care because he doesn't stand for re-election. So he can do whatever he wants, and then that's that. But the incentives for most people are to get your short run house in order, and that might incentivize things like buybacks.
Right. Shot's in the house. I'm glad, Shot, you found the channel. I know you're always on Doug's channel and Steve's channel, so I'm glad you're here. Maybe you've already been here. Can you post a few comments about where is it, Lynn Stout and Bill? Can you put that in the comments when you have a second, just so I can look them up later, and anybody else? I don't know if this chat will show up, but thanks for being here. Make sure you like, comment, subscribe, hit the notification bell. That helps me a lot. So we're at the point here. I wanted to do at least 30 minutes on this topic, and we've covered that. And I wanted to, obviously branch into other things, but I wanted the final say. And I know this is going to be a hard one because it puts everybody on the spot. Let me put me in the big screen here. Boy, oh boy, I look way better than Mike's chin.
Hey.
Our share by
chin.
Well, it shows your wisdom. It definitely shows that our share buybacks truly, I'll use a strong word, are they evil? Are they evil how they're made out from the progressive side of things? And I must nuance this, that I am progressive at heart, but I like to think I'm down the middle and I don't go to either extreme. But because I have a lot of progressive followers, I want to nuance to them what we're talking about today. Are sharebacks all that bad, or are they just, as Deerpoint was saying, a natural progression of a developed capitalist economy? I want everybody's thoughts on that, and just so we can summarize what we said so far in the first, 30, 40 minutes now. Doug, you can go first.
Yeah. I don't know if they're evil or not. But by the way, I have no problem if, as a society, and this would be up as a society, if we want to give some sort of incentive to companies to have more responsibility than just pure earnings. But I mean, as it stands, that is what we've decided we want. I'm actually going to answer your question with another question, and really, this is to your point. And see if you can refine this. One thing I did notice as I was kind of checking out the data here is that there did seem to be a massive run up from about 2002, just in terms of as a percent of total market cap buybacks into the great financial crisis. And I'm just wondering if you have any thoughts as to why that seemed to be. I mean, like if we were to see a massive run up again, is there something that we could glean as a signal to like an end of a cycle sort of thing? Because that is just kind of curious that jumped out to me in the data, and if you have any thoughts there. And yeah, I'm pretty agnostic on anything being evil or good to begin with. So I mean, it just depends on what you want the outcome to be and what the preference is for the person for the outcome. But yeah, that's kind of my question. If you think there's a signal there for buybacks and why they would ramp up so much before a big financial crisis.
Yeah, I mean, that's a good question, and it might have had something to do with coming out of the dot-com bubble, potentially, where companies were just like, instead of doing all of this investment, we might as well just buy back our own shares. But I mean, I'm not sure if you would have any sort of leading indicator from that run up. I mean, it would make sense that as the business cycle peaks and then turns over, that buybacks would kind of go along with it, right? Because you'd have reduction in free cash flow, and so as a function of that, you're just going to not do buybacks or capex investment. But I'm not sure if there's anything that can actually be derived as a signal of like trying to time the potential rollover from that.
Yeah, I guess I would say sort of a number of questions as well. Is doing share buybacks illegal? And if it's not, okay, the incentives are what they are. Managers pursue whatever strategies they pursue. Is it immoral? I don't know if it exacerbates the income inequality, wealth inequality, maybe. What do you do about it? I mean, now we're talking about redesigning the airplane to some extent. We're not presumably going to throw the airplane away and go to a communist system or something. So we retain the capitalist airplane, but we want to tweak it a little bit so it flies a little differently, faster, higher more fuel efficiently, whatever. If we were to say you can't do those anymore, share buybacks, what are the implications? And if it's a small, empirically, if it's a small number of firms, a small percentage, might not make any difference. If it's a large percentage, it might make a difference one way or the other, but it really cries out, I guess, for some modeling.
Okay, so I'm still gonna put Doug on the spot here, buddy. Let's not
What's up, man?
let's not use the word evil. Let's drop that. Okay, I know I made that hard on you. Bottom
Just
line.
always remember, Ty, evil spelled backwards is live.
Well, Doug, maybe it's time to do some living, some real living, just in reverse. But
Yeah.
okay, so no, maybe I should rephrase the question from a macro perspective, because me and you work in the macro world. Our share buybacks, maybe aggressive share buybacks that are systemic, which we are kind of seeing somewhat of a systemic share buyback process happening. Is that bad in the long term for the macro economy?
Yeah, just think again. I mean, I think it's just what is it that you want out of your macro economy, right? Like, I mean, you ask a degrowther, they're gonna be like, yeah, let's get as little growth as possible, right? Like, so they're probably happy that we're inflating financial assets away at the expense of new production and stuff, right? I mean, if you ask me, I want new tech gadgets and stuff like that, right? I mean, I don't know, I'm just a consumer, and so how do you achieve that over some other goal or something like that, right? Just so it depends on kind of what you want. I think the I think the thought I would have. I mean, I think like the systemic risk is just that is the financial economy gets bigger and bigger, and the financial economy consumes the real economy, that it becomes a systemic, like every recession becomes a systemic risk, right? Every drawdown of the stock market becomes a systemic risk, and like that is no fun for anyone. So I do kind of have that thought that just pops in the back of my mind, that it just kind of, yeah, I mean, it just makes more. It just share prices are what the economy becomes. And that's probably not a good thing for kind of real outcome. But the other thing too is, and this is why I like getting back, and we can kind of get into this debate. And I'm sure Dear Point would like to have a debate like this too. Like what is this is why I think I like higher interest rates, and this is why I think I like an environment, say more like 2020, 2021, 2022. I mean, I know that essentially got voted out, and the American people said no. But I mean, we saw more investment, we saw more of everything, right? I mean, wages rose more during that time. I mean, it was a hot frickin' economy. And a hot economy means you got to move fast. You got to make big moves. There's going to be a lot of winners, but there's going to be a lot of losers. To me, that sounds like the world I want. And yet, regardless, I don't think people want that. I mean, as it turns out, I really do think people want, kind of what we had during the 2010s, relatively low growth, moderate but low growth, low inflation, nothing crazy in terms of the innovation. I mean, nothing cool happened for an entire 20 years in the U.S. economy. And that's massive growth was essentially repudiated at the election box, and so and we're getting the reversal back to where we were slowly but surely. I mean, eventually the bubble that we're in is going to pop, and then I think we're right back there, because that's just what people want. And who am I to tell the people that they're wrong in what they want?
Okay.
I think that you can ask the question the other way too, not just what is the impact of share buybacks on the economy, but the economy on share buybacks. Now, one of the guys who taught me system dynamics here.
That is a system dynamics thought right there, is that there's a feedback loop there.
Right. But Jay Forrester, once we were having lunch or dinner or something, and he said to me, the way to think about what we do is at the firm level is that each firm is a boat, and the boat is floating on the surface of the ocean. And the ocean, like the economy, is going up and down, and it's not a sine wave. It's, there's irregularities. And the question is, as a sailor on a boat, you can't change the ocean, right? You can't change the economy from your firm. But what you want to do is use system dynamics to make sure that your boat is bobbing on the surface of the ocean as it's going up and down, and not listing and sinking and rolling over and stuff like ill-managed boats, ill-managed firms. So, when your environment is going up and down, and the economy, interest rates are changing as well, and so forth, when, if at all, is a share buyback a good idea? That sort of thing.
To your point, I kind of, Doug was mentioning there, and he said, "Oh, I'd like to open up a little bit of debate there about the high rate interest environment and a little more capex spending during 22, 23. What are your thoughts on his comments there around the high elevated interest rates, and maybe get your perspective on what he's saying?"
No, I mean, I think the biggest risk, and then I'll kind of go to Doug, is if you let share buybacks roll off, which has been a big booster of equity prices, what does that do to the flow of capital, right? And that's something that I think often about. And actually on my page, I got done modeling the impact of capital flows on the long end of the yield curve. And so for every 1% increase in capital flows as a percentage of GDP relative to treasuries, for every 1% increase you get as a percentage of GDP, you get about a 10 basis point decline in yields. And so that's on the treasury side, but also, it seems to be happening on the equity side as well. And I think that that's kind of been a big driver of foreign flows into the United States, is essentially that there is no other alternative, right? And I mean, for people who aren't in financial markets, the DAX hasn't done well really until recently. Euro stocks hasn't done well. The FTSE hasn't done well. The Nikkei hasn't done well. The TSX. I mean, do you really just want to own banks and insurance companies, right? So, no offense, Ty. I know you're Canadian, but
Sorry, Ty.
The United States is really the only people who actually have, companies that actually end up doing a lot, and really the only equity market that has done extremely well and hasn't just traded sideways essentially up until, the last year. But over essentially the last 2 decades, I mean, there has been no other alternative to the United States. So if you get rid of buybacks, what does that do to future equity prices? I think that it could be a prohibitor. But for me, I mean, I think high rates are good for the economy, actually. And I know maybe some people might not be a fan of Milton Friedman, but there is something that I think that he said that's true when he kind of wrote about the interest rate fallacy, and this idea when people think of lending. And I know a lot of people in the United States are like, we won't lower mortgage rates, we won't lower, credit card rates, so on and so forth. Well, the thing is, when people talk about that, they're only speaking about the demand side, right? Which is the consumer, right? Like when rates are low, you can afford a much larger house than you can when rates are high. But that doesn't say anything about the supply, right? Like banks who are actually going and lending the money. And if you actually go and you look at the spread, and you look at the cost of funds relative to lending rates, they're much tighter when rates are low relative to now, where banks are borrowing at 250 basis points and they're lending, let's say, for mortgages at 7, right? So that spread becomes much wider, and it becomes much more attractive for banks to start to lend. And so I think that somewhat consumers, especially large corporations, are kind of agnostic to the overall level of interest rates. And they're more kind of worried about their internal rate of return on those projects. And so I think that as long as, they can kind of clear that hurdle rate, they're going to continue to invest despite whatever, the interest rate is. And so I think that that's kind of the most important part. And I mean, we saw that when rates were at 525. CapEx, CapEx indexes where, the conference board, CapEx plans over the next 6 months was up. Actual real capital expenditures were starting to increase, and you didn't see kind of any sort of slowdown despite rates shooting up to 40-year highs. So, I mean, I think that that's something that's the economy overall has just been able to digest.
Okay, Doug, keep everything Deerpoint just said in mind. Mike, he's got to go teach the young generation coming up behind us. Any final words, Mike, before you go?
I love the concept of always thinking about data with something in the denominator other than 1 or 0, looking at relative measures. I think it's always much more profitable to look at numerical data in relative terms, relative to GDP or whatever. So I was applauding wildly but silently when those points were being made. So anyway, got to go. Good to see you all, and I'll give my your regards to my young students in 10 minutes here.
Perfect.
Take care, everybody.
Thanks, Mike. Doug,
And I still thought I was the young next generation. What happened?
No. Yeah,
old now, man.
Let's face it. So I've got the gray hair really starting to exponentially go on the sides. Doug, you've got a nice clean haircut, so and the gray is really going on here. Deerpoint, you're probably
that was I had some whiteout that I spilled earlier and just rubbed it on the beard. That is in fact not gray hair.
What Deerpoint said, what can you add on?
Yeah, okay. So this is something that I thought a lot about, had a lot of conversations about, because like, and I think I'm right about, but maybe I'm wrong. And I mean, I really just take a very kind of controversial view here, but it goes back to what Dearpoint was saying, is that there's two sides to every loan, right? There's the lender and there's a borrower. And obviously, if I'm looking for a new home, I want 0 interest rates, right? I mean, like everyone was happy as can be who owned a home when they could lock in March of 2020. I mean, they were practically paying you to have a mortgage. Rates were that low, but especially like if you're thinking about an economy and you're hoping that it can produce the most amount of output to generate economic output and well-being for the entire society, then that there on the lender side there has to be some reason to want to lend, and also from the banking system side, it really helps the banking system reach that first hurdle of risk-free rate that they have to get before they can then jump into the risky stuff, right? And the way that I like to think about this is just imagine, here is your entire pool of capital at the macro level. When interest rates are low, that means definitionally that there is a shortage of risk-free assets, right? And we know this because the risk-free assets balloon in price. I'm thinking primarily about treasuries, right? So if the macro level you have to allocate to various streams of income, right? Well, if this is your bubble and the risk-free is taking up this much of your bubble, then you've got this tiny little bit of space left for the riskiest of endeavors. Now, if this is your bubble again, if the risk-free is able to give you all the return you need, but it's only this small, I'm trying to get the circle right. Someone's gonna screen capture this and make a terrible meme out of it, but whatever.
It's actually going to be the thumbnail for the video when we're done here. I clip like that. Yeah,
great.
Congratulations.
Great. If out of the entire amount of allocated capital is and of that, the smallest percent can be to the risk free, and that generates enough interest return, so it's yielding enough, then you have room to take risk, right? That opens up the space for more risky things. Like the whole point of capitalism is 99 things are going to fail. You want the one thing that's going to succeed. Right. And that, it turns out it's the iPhone. It turns out it's, whatever. I don't know what else. I don't know what else has succeeded, but you get what I'm saying. Like things succeed. And like to me, higher interest rates open the space for more risk from the lending side. And as someone who just wants, really kind of progressive. Is like a futurist at heart. I think that's how you achieve that, and that would be kind of like my ideal world, and why I'm certainly not upset with high interest rates.
And Doug, I mean, I think that point that you made just about the shrinking of the riskiest bucket being lent to. I mean, even when rates were so low, and now people are starting to have um, this discussion about the systemic risk in private credit, essentially anybody who wasn't like Apple, Amazon, Google, so on and so forth, got completely shut out of funding markets. And like you're talking about people who are even in the investment grade space, forget high yield for a second. Like so many of those people then had to go to private credit markets
Interesting,
to
yeah.
essentially get funding, right? Because the banks were just like, no, if you were Apple, sure. If you were Google, sure. But because now, that bubble is so small, and you have such a small percentage of people that you can lend to that are the riskiest of borrowers, they get completely shut out of funding. And that's where you kind of started to see this rapid rise in the growth of private credit.
So basically, if you were a small time guy, you had to actually go buy your house first and then put a second mortgage on it and then get your funding that way. Or you probably went to venture capital, which is a competitive market in itself, and got your funding that way. Shot has a comment here. I just better bring it up so I don't. Allowing buybacks is going to explicitly disincentivize long-term
Disincentivize. There we go.
funding projects via retained earnings. I think buybacks directly compete with that and hurt our general innovation. We've kind of touched and danced around this, but let's give the audience a little bit of feedback, specifically. Shot there, Doug, I'll let you go first.
Yeah, I mean, he's probably right. I mean, again, but it's not the corporation's fault. Like, it's the macro economy's fault, right? Like, you can't blame the corporation. Now, I mean, like Mike was saying, like if you want to, incentivize certain investment, you can do that just by, give massive tax cuts, right? Do something like that. You can incentivize certain things. You can find certain activities. And again, I'm agnostic on any of that stuff. Do what you want, but it's not the corporation's fault that they're going to look out for themselves. I mean, none of us look out for anyone else but ourselves first, anyways. Like, why are we, and rightfully so. I expect everyone to do that. So Shot, just for the record, I don't think you're actually like necessarily disagreeing with what I'm saying here, but it's just the visceral response to this from people close to probably even the political leanings I have. I think just get better policymakers in office if you want a different outcome.
Anything to add on, dear point, to Shot's comment?
No, I mean, I would agree, but I mean, I do think, despite all the worry of, like, even some of the worries that I've kind of echoed, I mean, I think that things in the United States are fine. I don't think that we've become too hyper financialized. And so, like, I just believe that it's been somewhat of a migration to states that are more business friendly and states that will offer tax credits. And, originally, even, I mean, I'm sure people have derived this from my accent, but I'm obviously from the South. But, the interesting thing about that is now if you look at kind of like actual manufacturing and industrials, a lot of that has relocated to the South, like the state of South Carolina, where I was born and raised for the vast majority of my life. BMW and Michelin in upstate South Carolina alone employ 23% of the total labor force. And BMW in South Carolina makes all the SUVs. And that was broadly because of things like tax cuts and incentives for BMW to come in and actually start to build out employment. And then if you look at North Carolina, you have Raytheon, and then also down in Charleston, you have Boeing and Volvo, and then in Alabama, you now have Mercedes, and Tennessee has Volkswagen, and now you're getting Tesla in Texas, and I think they're opening a factory in North Carolina. So, like, I do believe that there's been a shift, but in the long run, there might be some, decentivization, I guess, of kind of overall projects, but I just don't think that we've been there. And I just think that this is kind of the function of like your late stage kind of growth model, where you just move from hardcore investment. You do that at the very beginning of like kind of as you, I guess if you were thinking in kind of theoretical macroeconomics, you'd move from like kind of a Malthusian, agricultural based economy, and then you start to get industrial output, and then you start to actually build your capital stock, and the savings rate starts to increase, and then people become much wealthier, and then they stop doing that domestically because there's no incentive, and it becomes much more expensive to do so, and then you become a service-based economy, and you just import the vast majority of what you need to drive consumption.
Yeah, and I could actually completely agree with that assessment. And so you can look at, there was a time where, America, coming out of World War II had to build up their industrial capacity. And obviously that took, a lot of CapEx to do that. And we're now in that stage, like you're saying, a service sector economy where we can still grow GDP, but with far less intensive capital expenditure, right? We can get that value out of the economy. And I've argued this as well, and it is sort of controversial because it goes against the mega right, maybe, that we're gonna open up factories again and make America great again. But that doesn't have to be the path forward to maintaining America's might. And I'm a Canadian, but still, you guys doing good down there. It's a reflection for us up here. We do good as well, right? It's kind of like Doug and I. If I do something good, generally it would help him, like finishing a model. Or if Doug does something good, generally it helps me. So to put that aside, I'm rooting for America, and I think that the case can be laid out that eventually you get to an advanced economy and it's service based, and there's nothing wrong with that. That's just the evolution of a free market system, and it's doing okay, right? And so if you're one that's left out of that system, which I sympathize with, because I'm lucky, I've had a lot of opportunities in my life, but if you are left out of that successful system, I can see the rhetoric around share buybacks. That's I don't have a job because of share buybacks, and that might be a little bit of a jump at the gun. Miguel, I don't know if there's much more I can say. Like, so Deerpoint and Doug have basically outclassed me in every respect when it comes to, looking at financial, share buybacks, corporate share buybacks. But yeah, that's essentially my argument, So, if you get a capital gain as maybe a wealthier person in the private sector, you're going to take that money, you're going to buy a new swimming pool for your mansion, which is going to increase profits for a firm, which a portion of that firm's profits, they will invest in a new truck or a new chainsaw or a new shovel or wheelbarrow. It's going to increase output because you get a bigger capital stock. He's probably going to hire a new worker, and that's going to increase the wages, the aggregate wages for an economy, probably push up wages a little bit. And then ultimately the cycle reverses because that's the cost to firms. We've kind of gone through that a lot, but I think what Doug and Deere have put forward is a lot more detailed than what I was thinking, and I have to reevaluate the blog I'm going to write now. I might need to find some more data, and I might have to nuance it a little bit more than what I first proposed. And my problem is, bottom line is, I put a lot of offhanded tweets out, and some of them stick and some of them don't. Sometimes I dig my own grave. But I'm like George Bush, when I've got something in my head, like going to war in Iraq, I'm going to go through it no matter what. And I'm going to stick it to the end, and we'll see how it goes.
Mission completed, baby.
And I will be standing not on an aircraft carrier, but hopefully a small yacht after I make my millions, and with the banner behind me, mission complete.
Well, all you have to do is pledge Vancouver real estate as collateral there, Ty.
Jesus.
That's probably, but actually, funny enough, Ty, I lived in Canada for 2 years. I worked for the Bank of Montreal. Okay. For 2 years in Toronto. And like, it becomes a double-edged sword almost, because At one point, I don't like the kind of protectionism talk, and I think that that's going to do a lot of harm. And me personally, I'm kind of a big believer in the Heckscher-Ohlin theorem of how countries kind of set the terms of trade. But at the same time, I mean, you can see what hyperfinancialization can do to an economy. And personally, I believe that that's where Canada is right now, where housing's, 15% of GDP. Like if you include the real estate sector and construction in total, and kind of this large commodities base has been broadly hollowed out. And like if you look at Canada as an example, you've had kind of stagnant wages, and there's not a lot of, mobility because most people either live in Vancouver, Toronto, or Calgary, and Calgary is very cyclical because it's based on the commodity cycle. And if you don't speak French, Montreal's not really in the cards. But like I think that that is something that I think is driving a lot of nations to look more at kind of protectionist policies. And I don't necessarily think that it's going to do a whole lot of good. But I mean, you can see that because Canada is a very wealthy country. Um, but if you look at the overall, like, kind of wage rate, and then you look at output per hour, and then you look at like total factor productivity growth, X commodities, like a lot of that has been drastically flat. Unit labor costs, even adjusted in U.S. dollars, are much higher in Canada than they are in the United States. And so I think that certain policies can, and you as a Canadian, be interesting to see your perspective, but it can do be a large prohibitor to kind of upward mobility where asset prices are increasing at a rapid pace, but wages are stagnant, and home prices, I guess, theoretically can only go up so high relative to people's ability to afford them, but nevertheless, they keep moving higher. So I'm not sure how to take all of that into perspective, but I think that this is where you're starting to get a lot of people who are, upset about the way that things are going. When, the vast majority of your industrial base might be companies that aren't, national companies. I think something like 60% of Canadian GDP is essentially from US companies, like theoretically generated by US companies, but I'm not sure if you have thoughts on that. I know it might be a controversial topic, but at least it's in the realm of macroeconomics. So.
No, it's not controversial at all. Like I've always said, Canada. Well, this is my fellow Canadians might get mad, but we're economically we're just another state of the U.S. Right? That's not a bad thing or a good thing. We evolved that way. We have a bigger trading partner to the south, and we've through time have capitalized on the customers down there. That's what we do. That's the great part about free trade, at least for Canada, and obviously it's a little bit suspect now. But it
I was
is
going to say that you mean that was the great part of free trade.
was the great, and it's a mutually benefit, especially for border towns and all the northern states. Like great for them too. It's just that's just part of our our economic ecosystem, right? It's how we kind of thrive on both sides of the border. One can argue that obviously, Canada needs the U.S. more than the U.S. needs us. However, if you think about things, very micro things, like unless you want potash from Russia, you guys are hooped. Right? You guys want to build, $30 billion refineries to refine your fracked oil, or you can just take our thick oil, right? So there are real tangible benefits where you can say, well, America might be a little bit hooped without Canada, but I try not to look at it that way. I just think of like the reality of how lucky we are to have pretty much the same ideals. I know political swings go back and forth, but economically, we're very much in tune, and we're beneficial to each other. And you can score keep what side it gives more than the other side, and in that case, yeah, you guys have 300 million people. You basically won World War II, and you kind of took the bull by the horns, and you decided to be a global leader. And in that sense, yeah, we need you more than you guys need us. but it's a
And
mutually.
Ty, we need you though, man. I mean, Justin Bieber, Celine Dion, and
I don't know about
the
Justin Bieber now. Maybe Justin.
That's changed. But
Avril Lavigne, one of my favorites from 20 years ago, man.
No,
You guys
you're
just
forgetting the best one though. You're forgetting Shania
oh,
Twain,
Shania Twain,
Yeah,
Celine
Celine
Dion. Did we
Dion,
go right?
dude. I
Like,
mean, like the
Seth
list,
Rogen.
yeah.
the list is long, man. You guys have some of the best exports in the
Now,
world.
now, as for high housing costs, there's the thesis that, private credit, mortgage expansion really is the main driver of that. And what have we seen in the US since '08 has been an uptick in deficit spending and a corresponding decline in many sectors of the private sector with private debt. Whereas up here in Canada, we're running up close to 200% of GDP in private sector debt, which primarily is mortgage debt, which is supporting the higher home prices. But there is an external factor, especially here on the West Coast, is we have foreign buyers coming in because it's a beautiful place. Have you ever been to BC?
No, no. While I was there, I mean, I was pretty much in Toronto and then Montreal. And like when we went from Toronto to Montreal, because the Bank of Montreal's like, their actual like old bank is in old Montreal. Um, like I just realized how long it takes you to get from like one place to the next because being in South Carolina, like I live in South Carolina, I work in Charlotte, but I live on the edge of North Carolina and South Carolina. So like I can be in Charlotte in 30 minutes and then Georgia in like an hour and a half. So like for me, like this concept of taking like, if you're going to Manitoba, I think it's like a 10-hour drive. And then to get into Quebec, it's like 6. So I was like, this is a big place, man. So I never got out to BC, no.
Yeah, so my wife and I, we just went to Calgary last month for the Calgary Stampede. I'm sure you've heard of the
Yeah,
Calgary Stampede, right?
fake
So
Texans.
yeah. Well, it is the fake Texas of Canada, all of Alberta.
Yeah.
But just to drive across to the next province, and especially going through the Rocky Mountains, like we had to pit stop at a hotel overnight and middle part of BC, and it wasn't until the next evening that we got into Edmonton, and then just going all the way down to Calgary's a couple-hour drive. But yeah, it's massive up here. But here on the West Coast, it's paradise here. It rains in the winter, which is kind of crappy, but we have our mountains, we have our glaciers, we have the ocean, we have alpine hiking, et cetera, et cetera. We have deserts here, right? So it's such a diverse climate that the world does seek us out, and so we have a lot of influx of foreign buyers, and we're trying to address it with. So what foreigners will do, they'll come here, purchase a really expensive asset, and just leave it sit empty, right? Which is problematic for society in general to just treat valuable land as an asset and it's not being used. And so we're trying to address that problem with vacant home taxes and et cetera, et cetera. I think it's just throwing darts at sharks in the ocean, in my opinion. But that's a big driving force. So nobody's consciously doing it, but a way we're managing it is we're pretty open to mortgage debt and high debt levels, credit card levels, and that's kind of allowed us to kick the can down the road. And we also have a strong fiscal spending up here, social programs, right, which is kind of allows that lingering high private debt to GDP ratio. So it is a far different nuanced situation up here versus the United States and how things operate. And I wish I actually had more time. Just nobody cares about Canada. So nobody cares. Oh, hey, Ty, have you built a model for Canada? Hell no. No, I'm going to work on the U.S. Everybody cares about the U.S. So I know less about my own country dynamically, like mapping it all out than I do the U.S. But yeah. Anyways, any questions in the chat? I'm not gonna let this linger a full 2 hours.
I'm gonna jump back to some comments earlier too, and just to kind of and then I'm sure I'd love to hear Deer's thoughts on this as well. But you were talking about like protectionist policies and stuff, and one of the things that's really been on my radar is the amount of taxes that are being brought in or tariffs that are being brought in. and the long-term impact of that. And then, this is really the MMTer in me coming out. Like, if you want to increase manufacturing, you want to increase that sort of stuff. Like, I'm all for that, right? And I don't think we have to give that up. Now, granted, I don't think any flipping American out there really wants to to be doing some of the hardcore manufacturing stuff. I mean, I don't think we actually have the labor force desire to actually want to do that. But I mean, it's a noble ideal if that's what you want. But the only way you're going to get that is it has to be a profitable endeavor. And the only way you can make it a profitable endeavor is if there's enough investment, consumption, and the feedback loop. Workers get paid and they can buy the crap they make for that to all pay out. And so if you're just removing money from the economy and throwing it in the shred bin, like you're never going to get the necessary profit motive to increase investment to support more manufacturing. I mean, essentially what I'm trying to say is, and I'm not going to give like any big props to the Biden administration, but what they did with the CHIPS Act is the way in which you would achieve more manufacturing, right? You would incentivize both directly via just straight up, here's billions of dollars, knock yourself out, sort of direct investment, and then indirect investment, whether tax cuts or whatever, some sort of savings or whatever other sort of law you can muster up to support that. That's how you're going to pull it off. And I think the big risk right now, from my perspective, I think we're there, is at this point, I think last year, fiscal spending. So if you look at the macroeconomy and you want to know where markets are headed, you really only need to know two numbers, right? You need to know how much more has bank credit risen from the year prior and how much more has fiscal risen from the year prior. And whatever that is, whatever that addition is, then that is what the net new add to growth is going to be, right? And at this point, we're on track. We had a 2024 deficit was 1.7 trillion, and that's about what we're on track for again. So we're having no growth on the fiscal side. All growth is coming from the credit side. Definitionally, I call that a credit bubble. Now, it doesn't mean the bubble has to burst per se, right? You can always, fiscal is exogenous, not endogenous. So you can always turn it back on, but there seems to be zero desire to turn that back on, even though fiscal is massive. And the problem is that when the credit bubble bursts, and it always will, that is just a cycle that has to play out. How much fiscal is there to support and come in? Are we going to, would we see like a stealth recession like 2015, 2016? Or is fiscal so bad, is a credit crunch so bad that we get a 2000 or 2008? And to me, I'm thinking, like, we're not in the best spot. Like, something's got to fix itself by early to mid 2026 on the fiscal side. Otherwise, I'm seeing some not so much fun outcomes maybe by the end of 2026 if something doesn't course correct really quickly here. Go ahead, dear. Yeah.
No, I would agree with that. And like more for me, like than just looking at outright banked, kind of my preferred, and it's showing very similar things, but is essentially trying to model out credits, which isn't kind of like a second derivative. And so that's something
Say
that
one more time.
we focus on.
You broke
like
up. You said model out. You broke up. You said you're modeling out something. You broke up, and then you said it's really a second derivative of credit.
Yeah. So the credit impulse, right, which was invented by Michael Briggs. Where was he? Deutsche, I think Deutsche, the economist at Deutsche. But so that's kind of what we focus on a good bit, and like essentially that actually leads real consumption and real investment by about 4 quarters, so a year, and that's starting to tick up. But I mean, it's essentially very similar to, I guess you could almost say it's essentially the growth of credit. But nevertheless, I mean, I think that as the way that things are going, I mean, probably not 2025, but more likely in 2026. I think that's kind of where we start to actually see the economy start to come down a bit from kind of the growth that we've seen over the last 2 years. And so then I guess the question is just how does the United States deal with that? Are they just going to try to make it up on the fiscal side, maybe where you get more of a fiscal impulse? But yeah, I think for now, growth is probably going to be, about 2.5%. And then going into 2026, that's probably where we'll start to see that bite down, because I don't think the credit can do everything. And then if you try to just rely solely on credit and you kind of get that bubble, like you said, I think that puts a lot of systemic risk kind of in the financial sector.
Yeah.
I'll give this thought. Like, so, yeah, I think you and I are on a very similar page. And credit impulse, I looked it up. It's probably exactly what I'm talking about, right? So, I mean, it really what matters is the second derivative of the growth of credit or fiscal, because that's where growth comes from. But going back, and this is my big worry. I mean, I have been bullish. Like I feel like I was the first person that was bullish and at the end of 2022. And I mean, I made that, and I've been like the bull in the face of everyone telling me I'm a effing whatever. I don't want to demonetize you here, Ty.
I'm getting very close to my 300 hours here in the last.
Nice.
month.
Okay. Good. Yeah. All right. Well, yeah. So I'll spare you the demonetization, but man, what really worries me is like out of all the cuts that have taken place in like the one big beautiful bill, like those are all cuts that are pretty much aligned with what we would call like automatic stabilizers, and like the sort of flows that would come in like save the day as the economy is starting to slow down. And that is my concern, is that just the fiscal is going to be so freaking late. And if this credit bubble gets sufficiently large enough, which I think there's every reason to believe that it is, right? I mean, like, we have a great catalyst for it, right? We have AI, we have systemic risk assets that need to continue to rise in price, like Bitcoin now, that are finding their way as being like necessary assets that have to rise on the asset side for the financial sector. Like we're seeing just like the classic, we've got to continue to create money to sustain this forever sort of environment. And it seems like it'll get big enough, fast enough, to where when you don't keep the sustained acceleration for growth, which is just an inevitability, that there won't be the fiscal there at all, the way the fiscal was there to, say, support us through 2015, 2016, right? And that's my, yeah. I mean, if it, I've been kind of ringing the bell that, hey, I expect things to continue to look hot as heck for the next year, maybe 6 months, and that's exactly what you would anticipate. I think too that a really good indicator is the worst macroeconomists are going to start saying, "Oh my God, the data's looking so good," because they're looking at data that is derivative of like massive credit expansion, right? The economy looks good when credit is expanding fast, right? But that is sowing the seeds of the very bubble that can pop and take it out. And so you're starting to see people who, granted, there's like the MAGA type that are saying this is the best thing ever. And if you just kind of delete those people out, you're starting to see people who are like, oh no, the data is actually looking kind of good now. Like that is actually the worry to me, because we know that credit is now accelerating fast enough that some of the soft economic indicators are starting to look hot enough. And I really think that, God, things could look really nasty by the end of 2026. And unless, here's the saving grace. It could be literally, I'll make a video on this later this week. Not later this week, it's Friday. Who am I kidding? We could see SCOTUS come and save the day and say that the tariffs, the unilateral tariffs of Liberation Day, were unconstitutional, and then that's just I created a little tracker to count up how much of a refund that would end up being, and my guess is by the time they would come to a conclusion on that, we'd probably be mid 2026, early 2026, and we'd probably be up to a couple $100 billion of a refund right to the corporate sectors. That could easily save the day here if that ends up playing out.
What do we got? Oh, Tony. I'll just Tony. Tony, we'll talk about it on Sunday. Every gas tank's going to run out eventually. Every planet gets enveloped by, its own sun, depending on what solar system it is eventually. So those realities will come somewhere down the line, but I don't think it's going to be in the next couple hundred years, to be honest. The limits of growth is the limits to growth. It's a good postulate, but I think we'll be okay for now, but we'll discuss it on Sunday. We got Tony Sunday. We're going to be talking about energy economics. One other thing, where was it? Reagan trying to troll me. Reagan, of course, I'm not saying that all profits are reinvested. The whole point of this stream is to show that no profits are actually being used to buy back shares. So I'm not postulating that. I named the stream something that's contrary to what you're saying I'm modeling, but I would argue that with legs over time, after you've got your operating costs, okay, and then after your operating costs, you got some sort of profits, however, whatever country you're in, and however your corporate structures define it. Then you've got your profits after taxes, right? So you've got some sort of net profits, right? And you can keep taking away your costs, and eventually you just have some cash flow left, right? And you can do what you please with it as a company, because guess what? You're a company in a free market society. But ultimately, somewhere down the line, after all your share backs and everything's done, the next innovation comes along, and there's one job you have as a company, and that's to invest in that innovation, get it online, and produce and make profits, right? So I'm not saying that all profits are invested. I'll often use it as a simplification in a simple model, but that's not the case at all, Reagan. Come on, Reagan, fellow Canadian. Sometimes we agree, often we don't. It is what it is. I don't think there's really much left to cover. I think we covered everything on share buybacks. I'm going to be reviewing this, and I'll be stealing, both of your guys' ideas for my own blog and calling it my own. And I will continue to get more and more paid subscribers. I'm just kidding. I will actually reference this a lot. But I think in totality, really, at the end of the day, I find what my original statement was on with that Twitter post is the share buybacks are a part of a capitalist system, and as Deerpoint was saying, in an advanced system, we're probably going to see more and more of that, and it's not necessarily a bad thing. And as what Doug would say, it depends on what people want. What does the company want? What do shareholders want? What does society want as a whole? What does society want in the constraints of a democracy where differing opinions come into play? It's quite a nuanced topic, but I think at the end of it all, I myself am not willing to vilify share buybacks like some people do. I think it's just part of the system and could actually be beneficial in the future. When a new technology comes out and corporations want to take that cash flow and put it into that capital stock. Any final thoughts from either one of you? I know it's kind of based around share buyback. Dear, tell us about your work. Tell us a little bit more about you. We talked about Canada. Let's actually learn a little bit about you. How did you get in the industry? What was your path in life? What are you doing on Twitter? Any projects you're involved in? Name them.
Yeah, certainly. So I guess I'll kind of get started on how I got on Twitter. Well, I'll do the industry experience and then Twitter. So, I spent most of my life in finance, all sorts of things. I worked in credit for a while, worked in reinsurance on the investment side. And now I serve as the director of macro strategy and economic research at a firm based out of New York. And so kind of my undergrad was in economics. Then I went on to do graduate. I was going to go into econometrics, but then just given working in the financial space, econometrics and asset management isn't something necessarily sought after. So I went and did an MBA in finance. And yeah, so just kind of things that I do on Twitter are just kind of linking macroeconomics and like financial concepts, right? And trying to essentially figure out the macroeconomic implications on different assets, whether it be mostly fixed income and FX, because those tend to be the two asset classes that are most closely tied to macroeconomic variables. And then that's just kind of how Twitter was born. Did a lot of things kind of when I first started Twitter. I was actually in Canada at that time. So I really started on the Canadian macro side because I realized that it was actually, funny enough, something that wasn't covered. The problem with the Canadian macro side is dealing with the Canadian macro people outside of like yourself and maybe a few others is unbearable because they're just so bearish about everything. It's just like you just cannot offer any sort of subjective, analysis because they'll just be like, nope, everything's messed up. We're going to hell in a handbasket, and it's just like, this is kind of unbearable. But then, yeah, it just kind of slowly started to creep into being more U.S. focused. I mean, I have some stuff on Substack from back in the day of modeling certain things in Canada, like the marginal propensity to consume, built a credit impulse for Canada. Looked at total factor productivity for Canada. I will say StatsCan is awful to work with. I wish it was more like Fred. It is so difficult and just not intuitive at all. I mean, I am very fortunate to have access to a lot of different data, whether it be like through Bloomberg or like FactSet or CapIQ or like any of those guys. But overall, that's kind of how I got started. And then, kind of my biggest thing that I look at is like I'm a big believer in total factor productivity. So I guess you could say I believe in magic. But, overall, I mean, I think that it's really the driving force to economic growth in the long run. So a lot of stuff that I do, at least on the macroeconomic side, tends to kind of be focused around looking at total factor productivity, trying to measure total factor productivity. I like the output gap a lot as well. I think that there's a lot of information, at least as it relates to financial markets within that. And so, yeah, that's just kind of how Twitter and everything else came to being.
StatsCan sucks. I'm not gonna lie. It's the worst turd of interface just to work with. And I always tell this to Americans is treasure what you have in the BLS, treasure the interface with Fred, because there is nothing else like that in any other nation, in my opinion. Which makes modeling economics in the US a lot of fun because it's so easy to have a free data set right there at your fingertips, versus a country like Canada, which would be a nightmare unless you've got the terminal from Bloomberg. You're kind of hooped, or you're doing a lot of work to extract that data.
Even with Bloomberg, man, I mean, this is if there's one thing that's made me extremely sad with regards to what's been taking place and the cuts for like spending cuts in terms of what the country provides for its people here in the U.S. in terms of data. Like the U.S. data is so verbose. There is just so much information at such an high frequency level too. It's so scary that some of that data might end up going to the wayside. I mean, there is no other. You're giving the look like you got to go, dear. So I'll
No. Somebody just came in. He was like, "Are you on the phone?"
Yeah,
and I was
nice,
like, "Yeah,"
nice.
and he just left.
U.S. data is just insane. I mean, it's incredible how much data there is for the U.S. side and Fred. And I hope none of that goes to the wayside. I mean, crap, even stuff like the H.8 report, to the Z1, to all the stuff that the main BLS and all those sort of put out. It's we have incredible data, and there's nowhere to get any of that. I mean, I know people will ask, you can do this for Europe or something like that. What we do, and it's like, man, I mean, at a very slow pace, yeah. Like, I mean, but you just can't get that sort of data. So,
Data, yeah. There's somebody. I think one of y'all follows him. So if y'all can remember his that'd be great, because I wanted to quote him on the Substack because somebody put out something on a post-Keynesian growth law kind of way that it would be modeled theoretically. Um, and then I took that math. I just don't remember who it was. And then essentially tried to build out a model based on that from ChatGPT. But he posted like kind of a snippet from ChatGPT, and I just saved the snippet, but I should have saved the whole screenshot, and I just can't remember his name. But I think because I just remember I didn't follow him, but I think one of y'all did.
I don't. If I saw it, I don't remember seeing it. Yeah. My memory is getting bad too. Is the
What's it called? The Keynesian growth law?
Yeah, it was like a post-Keynesian growth law.
Post-Keynesian. Okay.
Yeah.
Interesting.
So just like essentially it was like isolating the investment piece or like the part of GDP growth that can be explained by corporate reinvestment of retained earnings. But I don't remember who put it out.
Interesting. I'll take a look, see what you're talking about. Sometimes, I always wonder if I'm having an earthquake here. We're waiting for the big one, and now they're doing construction work, and I'm feeling these rumbles. I'm like, this would be so cool if this happens live. Like, way to go viral, Ty. You have arrived, but I don't think it is. I think it's construction. I'll have to check that out. I don't actually like a post-Keynesian modeling, mathematical modeling, but no more than I like a new Keynesian modeling. I think it's a little bit bunk. But I'll have to check it out because I've never heard of it. Actually, to be honest, to your point, I don't like conventional economic. What you were talking about, like econometrics and all that stuff. It's all very laughable to me. And I can say it's funny.
We gotta get you into system dynamics, dear.
Yeah, it's funny. It's funny. It's almost a validation when you actually went and applied, what you learned in the real world, the private sector. You're like, pretty much couldn't use that anymore. It's like that's just a validation of the academic economics, and it stretches across both the heterodox and conventional mainstream. So it was a bit of a validation to hear that you should learn some system dynamics. It's a cool little tool, right? And if you can do a little bit of econometrics, it's not a hard thing to pick up over time. And it can be a cool to measure like acceleration, right? So the rate of change and see how that impacts the system as a whole. Of course, it's non-linear. Econometrics, it's just all linear.
Yeah, macroeconomics in theoretical senses is always just linear.
Yeah, it's I can't look at a complex system that way. Like every other science that looks at systems, whether it's like biology and predator prey models or engineering that looks at a complex system, they accept it's nonlinear. You're going to get some chaotic behavior out of it. But I'm happy to hear that you kind of were like, yeah, that's kind of monkey shit stuff, and I work in the
Dear, hold on. I don't think Deer thinks that though. Sorry, I'm going to stir the pot. Deer, you still use your econometric chops, right? I mean, you still put them to good use, right?
Yeah, I mean, I still like use it, like that post that I posted on, capital flows impact on, treasuries was just like essentially econometrics. But, and I know Ty's probably going to block me, but you had R star in there and things like that. But, to some point, that's just. Yeah, like I feel like when you're like, especially when you're trying to give stuff to like, research analysts, you have to keep it where they'll understand it, right? And so like, like they understand term premia and like, R star and all of those things. But if you're like, yeah, none of this exists, they're they're just going to be like,
Yeah,
This
trust me.
work-
I face pushback on the fact that when I say R star is a construct of a model and not a phenomenon in the real world, I get some pushback from the academic insiders and some people in markets who are trained from that. It's hard to let go of that, and I understand it is hard to let go if you're paying tens of thousands of dollars for an education and you've got these professors that you may look up to into a small degree. Let's say it's hard for a guy like me to come along and say, well, that's pretty much modeling horse shit. Here's the reality of it. I get that, right? And I get that it might even come off as arrogant and condescending, but the thing is I never approached economics from a background in an economic undergrad, right? So to me it's fallacious, a lot of these optimized equilibrium. That is not a thing in the real world, right? So it's all very fallacious to me. We'll highlight though, hold on, Doug said that because you do use linear modeling. I will say follow Deerpoint Macro on X. He's got a lot of interesting charts, and I don't follow many people. I follow maybe 250 people, and Deerpoint Macro is one of the people I follow back. So make sure you give him a follow. I doubt his background is just as bland as some linear modeling. I used linear modeling to look up relationships. So don't get me wrong. Like if you're doing a statistical analysis, you're going to use correlation coefficients. You're going to use linear model, right? Linear modeling. You got to do that in your research. But I sum it up into a non-linear system, which kind of then throws out, aside from my behavioral functions, I don't use, linear modeling after that. Doug, sorry, I cut you off. What were you going to say, buddy?
No, it's all good. Forget what I was going to say. I don't know. No, I know
You
what I
know
was going to
the
say. I know.
funniest
Go
thing,
ahead. I'm sorry. I will remember. I'll write it down. Go ahead, dear.
No, the funniest thing that I was going to say is actually the way that I went into economics was in high school. I read 2 books. So when I went into university, it was kind of a real eye opener of how kind of nonsensical Austrian economics was. But my first book that I ever read was The Theory of Money and Credit, and then I read The Anatomy of the State. And so before I kind of went into economics, I was this hardcore kind of Austrian, and then slowly.
That's how we all start, man. That's how we all start. Is we are all disillusioned Austrians. Yeah. Is the path.
Except the Bitcoin spaces. I think those guys just read the Cliff Notes version, right? Because if you ever try, it's so that was just a funny tidbit.
Man, what I was going to say. Okay, you made a point how you got to write something that an analyst can digest and go. You can't make it too complex and that sort of thing. And I'll tell you, I've got a good friend and she works in an industry. I won't dox her, but so I'll make this as broad as possible. But where statistical relationships are it's literally how they're going to make their money to be right on this sort of stuff. And we've had conversations about some of the stuff that we do in terms of modeling macroeconomics. And she's like, yeah, I'm pretty much stuck working with these linear models because every time we've ever tried to do anything that's a little bit more complex, you hand it off to the analysts and they're like, I don't know what the hell you're talking about here. I don't know what to do with this, or you hand it off to other stakeholders. And again, the industry she works in, if they're wrong, that's a massive systemic risk. And if they're off on their tails, we really don't want that. And it's funny that you say oh yeah, make it digestible for the analyst, but that's I think what Taleb is trying to get at, where it's no, there's so much chaos and complexity that is so baked into everything, but we have to create this to the least common denominator in a way to explain it, which is, it's no one's fault. I'm not saying well, it is, but I'm not saying that you're wrong to do this, but that jumped out at me. And I'm yeah, I've heard this before, where we really just, if you sit there and explain that it's this massive complex system, it's just going to be in one ear, out the other, and no one's going to listen to you. Go ahead.
Well, hopefully nobody from the firm's listening, because there might be an analyst on here we had to do this for. But I remember we were trying to run some correlations on asset prices, and in the model, somebody was like, what's a p-value? right? Because like we had like and we were like, okay, so like we really have
please tell
to
me this
like.
was at least before ChatGPT, and they couldn't just quickly look this up on the side. I mean,
No, it was this was like very recently, probably like 3 months ago. But it just kind of goes to show, and even like if you start to do like, even if they're like linear econometrics models, but you try to like put the math in there, like for a lot of people, like even guys on the research or the trading side, like they're just not going to know what that means, right? So it's you kind of have to do things where it's easily digestible for one, like because you're also distributing this to readers
yep.
of the firm's research, some of which are also like just you know retail folks. They're not gonna like want to read like an appendix on like an econometrics note. Like they're gonna be like, what is this, right? So that's sometimes kind of the prohibitor to doing like more complex, but I might try to start doing that, at least on to your point, maybe fooling around with nonlinear modeling and stuff like that. But
And so I think so you're right. There are limitations. Like a retail investor, it doesn't matter what mathematical methodology you're using. They're not. That's gonna glaze up their eyes. They want, a pinpoint, precise summary of what they need to do. But if you go into, the back rooms, in your offices there, really the fundamental change that needs to happen there is probably from the university system. So people like Steve Keen that's tried to push it, but he's in retirement now. That train is ended, right? There needs to be a more fundamental education around that, early on in your first or second year undergrad. So those concepts are more available and accessible. So when they do graduate into the private sector, places where you're working, those conversations can be had from that perspective, and everybody's like, okay, I get that. Miguel, just so you know, this is actually the Mr. Keynes and Dr. Keynes, the economic live stream. He's generally on here every week. He's just away in Thailand right now. So that's why he's not here this week. And my modeling is actually based on his, like the core of it, his PhD paper. So he's my modeling's fine in the Steve Keen realm of things, but we'll leave that for another discussion another time. See ya. He'll be back next week, Friday, 1:00 New York time. I'll be back Sunday. I'm going to talk to Tony about energy. Tony's a rough and tough Australian, more unshaven than me, swears a lot. I'm going to have to tell him we're not on the Steve Keen channel anymore. We're on the Try to Help Ty Monetize It channel. So hopefully he tones it down. And then Tuesday, I'll be back at 1:00 New York time for another reaction video. People like those. Right. Generally, I'll pick a video where I don't agree with anything in it. Makes it more interesting. But that's about it for me. Any final thoughts before I shut this down?
Dear, it was nice talking to you, man. I know we've had a few conversations on Twitter, and I think we've jumped on a few whatever they call them over there.
Wait.
Spaces. Yeah, right.
Hold on. This is so I thought you were a completely different person. Okay, so I was watching a live stream yesterday, and were you on it? It was.
Yeah, it was.
Were you on? Okay, I confused. I thought you were the completely different guy, and you came on, and so I'm looking at him like, either I'm like having delusions in my mind, and I've watched too many videos on the internet, and I'm confusing people, or that you somehow infiltrated the stream. I'm like, well, we're just gonna go with it. Okay. So you were in it. There's 3 people. I only watched for a few minutes. I was working at the time. Okay. I thought.
Yeah. The space.
Yeah. Okay.
Yeah.
It was a live. It was a video live stream, right? Yeah. Okay.
It was video live stream. Yeah. But no, I just wanted to say thank you so much for having me on. Because if I get my phone's on 1%, so if it gets shut off, I just wanted to say thanks before.
Cool, man. It was good chatting.
I got to go plug it into the charger.
Good chatting, man.
Yeah.
Yeah, no, it was great, and thanks for having me on, Ty. And it was finally nice to meet both of y'all on live. So it was
We'll,
great.
we'll do it again. We'll do more live streams, whether on Doug's channel, my channel, maybe your channel. We'll keep doing this into the future, and we'll keep the conversation going. Until then, everybody, make sure you hit the like button, subscribe, notification bell, and comment. See you later. Bye-bye.
You are now relearning economics.